Welcome to the All Financial Hour podcast with Steve All.
Warren Buffett's Berkshire Hathaway has a big pile of cash. When I say big, I'm talking about $334 billion, guys. It's leaving many to wonder if he's waiting for a big opportunity in the stock market. So, while we don't have Warren Buffett money, it's estimated that American investors have close to a record $7 trillion in cash on the sidelines. And we've heard this before, right? People put money under the mattress, and that's no way to go. So when clients reveal that they're sitting on a sizable amount of cash, Steve, where does the conversation go from there?
The big thing when it's sitting on, is there a reason? Like some people say, I'm waiting for a dip in the market. Market timing is very difficult to go through. But a lot of people, that's their investment philosophy. That lazy money, the money that's currently sitting in a checking account or a regular savings account. There are other options for that. You can go to the fixed annuity that looks kind of like a CD, but it's by an insurance company where you get a rate for a certain amount of time. The fixed indexed annuity cannot lose money due to market volatility. So I got some market exposure because that's how it pays the interest, but I can't get a loss. There are things out there called structures notes that give us different ideas that we have, that we can put those in to limit the risk. And then we get to the overall investment market. We do have things that are for very aggressive investors, individual stock portfolios, or just a lot more safe. I don't have to make a whole lot. I just don't want to lose a whole lot. So we've got a wide range of things. Mike and Mary, they came in, had about $800,000, all in cash, CDs, and checking accounts. And when we ran the analysis, it was like, you guys will probably go broke safely. They weren't going to keep up with inflation. That's the battle when we start going to all cash portfolios. If you got a lot of lazy money sitting around.
Steve, for those that are interested in coming in for this risk-reward analysis, or maybe just come in general and talk to you about, getting this whole retirement planning thing off the ground, what's that first appointment like?
Well, what we do on the first appointment is a lot of times it may be with me, it might be with my paraplanner. Usually it's a lot of times it's with the paraplanner. We're going to gather your information. We're going to find out what your wishes, hopes, and dreams are. What's retirement look like for you? Then we're going to gather those assets so that we can actually run a risk-reward analysis. And then we're going to bring you back a week or 2 weeks later, and we're going to go through that summary of a plan. It's going to talk about the different things. How are you going to replace that paycheck in retirement? Mm-hmm. What about taxes? Risk-reward. Fees, we like to talk about that up front. And then we look at legacy planning and taxes. Those are the things that we're going to cover in it when you come back.
The stock market has touched record highs throughout the last 2 years, with tech stocks leading the way. And then you have portfolio manager Keith Gangle here. He tells Yahoo Finance that investors really need to pack an umbrella.
I think we're going to have some kind of corrections as we go throughout the year. A 5 to 10% pullback shouldn't be a surprise. So we're warning investors that they need to bring an umbrella, prepare for a little bit of rain. If you were a 60-40 client, a couple of years ago with the big run up in the stock market, now you're more like a 70-30 client. So what we want them to do is rebalance, get back to that 60-40 where your original plan was. So that's what we mean by bringing an umbrella.
Okay, interesting take here. I think we all could agree it's been sunshine and rainbows for quite some time. A lot of us waiting for that other shoe to drop here. So what are you telling clients who have most of their retirement savings in the market, Steve?
Well, you start to look at it with most of you in the market. I think Keith talked about two things that are very, very important. The first one, 5 to 10% pullbacks are normal in a market cycle. They're not anomalies. They're normal. They happen almost every year. So these things that we have, we had the Trump bump. Now we've given a lot of the Trump bump back. So we've have those ups and downs in the markets, and a lot of people are, what's going on now? The other thing that he mentioned that I believe most people don't do, rebalance your portfolio. I think that's very important when you go into your investments. And I think that's what's advantageous when you have an investment advisor to help you. Because we want the best return that we can possibly get for you with the least amount of risk possible. And with Market Guard, that investment philosophy, it uses non-emotional, methodical, mathematical approach to answer the questions that almost every client has. When do we hold? when do we sell? And if we sold, when do we re-enter back into the markets? Those are the questions that most people ask. You know, am I too, should I back away? Should I do this? And they allow emotions to get involved with it. I think that's the thing that makes investing the hardest is emotions. I have emotions. Every investor has them. It's my job to come down and kind of calm down those emotions. So if you've been asking yourself, should I hold? Should I go ahead and sell? And if you sold a while back, when should you re-enter the market? Give us a call now. Ask about Market Guard. Let us talk about those non-emotional, methodical, mathematical portfolios that help you do what you want in retirement and answer those big questions. Do I hold? Do I sell? And if I sold, when do I re-enter? Give us a call. Ask about Market Guard.
You may have heard this guy's name before, Clark Howard. He is a nationally known consumer advocate. He's helped a lot of people with their personal finances over the years. And recently he was asked about how to save money for retirement. Here's his take. And of course, Steve, I want to get your opinion in just a second.
After age 50, you're even allowed to put in mega dollars beyond what somebody younger than 50 can do. Put the money in a simple fund. My favorite, a target retirement fund.
And that, by the way, Steve, is not something that we talk about here on the show. Do you agree, disagree? What are your thoughts?
The target date funds are what is available in most 401k plans. If we look back into the late 90s, early 2000s, 401ks had so many options out there. You could buy your own stocks. You could do this. You can do everything with it. But after the fall of 2000, the company couldn't tell people how to invest their funds. So people were overwhelmed with the number of options that they had. So less people were participating. So they started to move it back and they put target date funds together. What is a target date fund? It'll say if you're going to retire in 2035, pick this fund. If you're going to 2040, this fund. 2045, 50, going down to different funds. The problem with the target date fund is they're not all the same. The target date fund within your 401k plan might not be the same one as your spouse's. The different scales that they have are completely different. The other things that I'm not as big on target date funds, the risk reward doesn't care. It doesn't care if you're a conservative investor or an aggressive investor. It's only asking one question: when are you retiring? It doesn't look at the fact, do you have other assets? It's just that one asset all by itself. So I am not a big advocate. I'm not going to argue with Clark when it comes to maybe starting or in the beginning, picking a more aggressive target date fund. But if you're 59 and a half and you're getting closer to your retirement date, we need to look at it and see how much risk you're actually taking in that portfolio. And will it give you the return so that you get what you're looking for in your retirement? After you're 59 and a half, in most cases, you can roll the money out of your 401k. That is a non-taxed event, as long as it's done properly. Then you have a lot of different options. You can keep it in conservative funds. You can be more aggressive. If you need an income stream, you could look at something that actually would give you guaranteed income for the rest of your life. So there's a lot more options once you pass 59 and a half.
You know, when you finally retire, you leave a lot behind, right? You leave the agenda, the money, the alarm clock, you name it. But the one thing you can't escape is that tax bill. And in fact, income taxes might be your single largest expense in retirement. Steve, we've talked before, taxes are on the top of lots of folks' minds out there. So how do you kind of walk through these tax worries?
Well, we look at taxes, and I got to reflect back a little bit in the 70s, the late 70s, when the 401k came into plan. What were we told? We were told, if you put your money into this plan, we'll give you a tax deduction for it now. It'll grow tax deferred. After you're 59 and a half, you can pull the money out of the account. It will be taxed after 59 and a half, and it will always be taxed. And when you're in a lower tax bracket, you can take that money out of the account. And when you pass away, your children can stretch it over their lifetime. A lot of those things that we heard back then aren't there today. I ask the question, how many people that are retired that come to my presentations are actually in a lower tax bracket? Most of them aren't. Most of them are in the same tax bracket. And then I ask the question, have you thought about when RMDs kick in or you lose your spouse, what your tax brackets are going to be? Mm-hmm. And then we also ask the question, do you think taxes are going to be higher or lower in the future? Almost everybody says higher. The one that killed the most is that used to be one of the best tools that we could pass on to our kids. Now we're going to pass a tax time bomb onto our kids because they can't stretch it anymore. They have to take it out of that tax deferred shell in 10 years. Do you imagine if you took your amount in your 401k and said your kids got to take this out over 10 years? Do you think they might be in a higher tax bracket?
Of course, yeah.
That's why we want to look at it and say, are you going to pass on a tax time bomb to your kids? The only way we can find that out is for you to call right now. If you got more than $500,000 in your IRAs and 401ks, give us a call now. Ask for the tax analysis. Now, we do the $500,000 because that's where Roth conversions and tax analysis start to make sense for people.
Thanks for listening to the All Financial Hour podcast.
Insurance products are offered through the insurance business All Insurance Group, LLC, AIG. All Financial Group, LLC is an investment advisory practice that offers products and services through Impact Partnership Wealth, LLC, IPW, a registered investment advisor. IPW does not offer insurance products. The insurance products offered by All Insurance Group, LLC, AIG are not subject to investment advisor requirements. IPW and All Insurance Group, LLC, AIG are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. All Financial Group, LLC is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by All Financial Group, LLC.
This radio show is intended for information purposes only.